Good morning, entrepreneurship kids. It's Mr. Fritch again with your materials for the week of Monday, May 4th through Friday, May 8th. Once again, you're going to have this video in here. You already have the unit notes, the unit assignment worksheet that's due on Wednesday, and the unit test, which is open notes, due on Friday by midnight. All right, so let's just jump right into the notes. All right, give me just a second to scroll back up. All right, accounting unit notes. I do want to go through the definition of accounting. Accounting is the process of identifying, measuring, recording, and communicating economic information to permit informed judgments and decisions by users of that information. So if you're thinking of investing in a stock, you can go to their accounting, their financial statements, and look and see how well the company's doing, how well you think they'll do in the future. All right, accounting's name is called the language of business because that's exactly what it is. It's the language of business. All right, in accounting, they use financial statements to present that data. Two of the biggest ones are the balance sheet and profit and loss statement. Real quickly, in the balance sheet, it shows what a company's worth. How does it do that? Well, it takes its assets, which are things that have value that you own, such as inventory, your equipment, your delivery vehicle, your uniforms, your menus, all those things that have value that you own. You subtract all the things that have value that you owe to others, known as liabilities, and you end up with owner's equity. That's what your company's worth. It's the net worth of your company. All right, assets minus liabilities equals owner's equity. All right, and then I have some definitions for current versus fixed assets. Current assets are assets that are going to be turned into cash within the next year, like inventory that you're going to sell over the next few days or a few weeks. Fixed assets are things that are not going to be turned into cash in the next year, which are things like property, plant, equipment, things like your delivery van, your equipment at your factory. All right, those are fixed assets. Next, there's one term that I need you to also understand is depreciation. Depreciation is used to illustrate the decrease in value of an asset due to age and use. So if you buy a delivery van for $20,000, each year that you use that van becomes worth less. So you have to depreciate it a certain amount each year. If it has a useful life of 5 years, then you have to depreciate it from $20,000 down to zero over the next 5 years. Second one that I mentioned to you, second financial statement, is the profit and loss statement, which is simply, it shows how much money the company's making, if it's profitable or not. It compares your revenue, which is all the monies that you're bringing in for selling your goods and services. You subtract all the cost of goods sold, which is when you buy, let's say for a pizza shop, you buy ingredients to make a pizza. Well, those ingredients would be considered cost of goods sold. There's also fixed costs versus variable costs that you can get into. Payroll. All right, this is what I want to mention, expenses. So if you take all your expenses and you subtract them from your revenue, that's going to give you your net profit. That's what's left over after taking all the money you bring in, taking away all the money that you pay out for the different expenses. The leftover amount is called your net profit. All right, and then there's one more financial statement that I mentioned here, startup costs. It's just all the stuff you spend money on before you actually start your business, before you start selling your first pizza or your first car, whatever you might be selling. All right, things like setting up your corporation might cost legal fees. All right, you might have menu costs before you open your restaurant. You might have to buy uniforms before you start your business. There's a lot of stuff you have to spend money on before you actually begin selling your first good or service, and those are called startup costs. All right, accounting ratios are sort of like financial statements, but they compare two different results, financial results, together, and you get a mathematical percentage. So, for example, the current ratio is looking at how easily the company's going to be able to pay bills. It takes your current assets, which are assets that are going to be turned into cash shortly, divides it by your current liabilities. Those are liabilities that you're going to have to pay within the next year or shortly. And that ratio will give you how likely it is that you can make your payments. The next one that I mentioned is the price to earnings ratio, or the PE ratio. That is when you take the market price of your stock, whatever it's trading at on the stock exchange, and you divide it by your annual earnings. And that gives you your P&E, or your price to earnings ratio. That's an important one to compare against other companies in your same industry. All right, and then I talk about bonds. Bonds are simply a way of borrowing money. If you want to raise money for your corporation, for your business, and you don't want to sell stock in it, you don't want to give up any ownership, you can sell bonds. That's when you take in money, people buy your bonds, and then you promise to pay them interest payments over the next whatever 5-10 years, however long the bond has in its life. Let's say you issue a 5-year bond, then you're going to be making interest payments for 5 years until it finally matures, and at the end of it you have to pay back all the money that they gave you in the first place, the money that you borrowed from them. All right, and then I mentioned 3 different types of bonds that you can go through on your own. They're pretty straightforward. And then I have a bunch of accounting terms that, once again, you can go through on your own. I do want to mention a couple here. Commodities is a tough one. Commodities are goods such as grains, metals, oils, foods that are traded on an exchange, such as orange juice or pork bellies or silver. Things that, if you buy silver, if the silver that you buy in Turkey is the same type of silver that you buy in California. So silver can trade as a commodity, if that makes any sense to you. Wheat is a good one. The wheat that you grow in Kansas is basically the same wheat that you grow in Colorado. So it's just considered a commodity, that your wheat's no better than someone else's wheat. And all the wheat trades together on one commodity. All right. And then I give you an example of some startup costs. And I give you some example of operating expenses. All right. So with these notes in this video, you are going to go back and you're going to complete the assignment worksheet and then also take the notes, or the open notes test. If you already have taken the test, because this unit was assigned like the first week that we were out of school, you don't have to take the test again if you don't want to. But more than half the class never took the test. Close to, I believe it was 70% of you never took the test. So I need you to go back. If you've already done the test, you don't have to take it again. If you want to improve your grade, you can. But everyone does have to do the worksheet. It's different than the first worksheet. It shouldn't take you that long. If you have any questions, please email me. As you know, I'm here 5 days a week, 8:30 in the morning until 2:30 in the afternoon. And then I do check my emails all night long, maybe every 2 hours from 2:30 until I go to bed that night. So if you have any questions, any comments, any concerns whatsoever, please email me. All right? All right, that's it for this week then. Have a great week, and I hope everyone stays healthy and all your families are healthy. All right? Bye-bye.